All right, thank you. Thank you, Ann. It's a great pleasure to be here. I love speaking to people. And the topic that we have tonight is about your estate plan. And no matter what I speak about, sometimes some of the things get to be kind of mixed in. Many things get mixed in with more than just one topic. So when we talk about your estate plan, probably the greatest thing that all of us are either aware of or not aware of is that we have an estate plan. Your estate plan may be have a great deal of thought and sometimes a great deal of work and sometimes a great deal of expense, or your estate plan may sometimes be almost nothing, and that term that when we fail to plan, we plan to fail, that follows along with that estate plan. Another topic that goes along with that discussion about estate planning is not so much who you leave it to. Most of the time, we're not going to have spent all of our estate. And by the way, when we talk about estate, I think a good thing, in my opinion, for you to be clear on is that's an estate means what you leave behind. And whether it's sometimes in reference to somebody that has millions and millions of dollars or someone that has hundreds and maybe thousands of dollars. Doesn't make any difference, but you still have an estate, and there's still something that needs to be done with your estate. And when people plan real well, it's usually a great benefit, isn't it, to those that are left behind? And when people plan real well, it's usually very efficient in terms of time spent by those people. And it's also usually very efficient in terms of the expenses that occur. And the discussions that we're going to have tonight are just going to be kind of general. I promise you I'm not going to tell you what to do, but I'm going to give you some ideas about how you can manage your estate and hopefully give you some ideas about how we can deal with some of the issues relating to not only the documents that you have, which are help you, if you could click it forward a little bit, the documents that you have, which are usually prepared by an attorney. And I have with us tonight an attorney, and her name is Rachel Bowman. And Rachel is right in the back of the room here. And because I'm not an attorney, it was recommended by my company, Edward Jones, that I not give legal advice. Do you think that's a good idea? Because certainly I could get myself in trouble. So there may be a few questions. I'll hopefully have a few questions that we might ask Rachel. Rachel has been an attorney for a number of years. I'm sorry I don't have her whole biography, but she's just a very nice lady. She works in the same building that I do, and I asked her to be here tonight, and I really am happy you're here tonight, Rachel. And so with that said, it's not just the issues that relate to the documents that you have. The documents are extremely important, but it's also the tax issues that relate. And again, I'm not an accountant, and I'll probably give some advice to you tonight about efficiencies of gifting and efficiencies with some tax issues relating to your estate. And I wasn't required to have an accountant here tonight, so that I didn't bring one. We don't want them here anyway. And then things that we'll talk about relating to your financial plan. And your financial plan, click it forward again for me, will you please? Or to the next one. You know, the financial plan has a lot of things involved with it. And as I look around this room, there's some things that we probably won't spend a lot of time on. And that's like preparing for retirement. I don't think we'll do that. I don't think it looks around the room like we don't have to spend a lot of time with that one. Wasn't planning to either. But a little bit about living in retirement, a little bit about paying for education. And we don't need to spend a lot of time on that because most of the people in this room, it looks like, have probably already had children that went to school. But if we want to have discussions about college planning for maybe your grandchildren or something, we might spend a little time. And the reason we might is because that also affects issues relating to your estate. And then we'll talk about a little bit about planning for the unexpected and then planning your estate or inheritance, which I think we'll probably spend a little bit more time on with that. So if we would click it again forward. the key to this whole thing is always having a plan. And whenever we have what we call a 5-step process, and that 5-step process that I work with my clients with first of all starts with where am I? And so somebody might come and see me and they're 40 years old. Where am I? And what do I want to do? I want to retire someday. Or somebody might come and see me and they're 65 and they're just retiring from selling their business, or retiring from doing maybe working at IBM or at the Mayo Clinic. It doesn't make a difference. But what's my goal? Where am I? Where would I like to be? As I look around this room, probably more than likely the discussion is, where would I want to be? Well, I want to maybe do the things I want to do. I want to be able to financially do the things I want to do, and that would be one goal. Second goal would be I want to do it as efficiently as possible with my estate. And a third thing would be is, how's the best way to pass this thing on to my family? And so can I get there? How do I get there? And then how do I stay on track? I think with that said, maybe click it one more time. Yeah, that's okay. That's a weird slide. I didn't want to put that in there, but we got it there anyway. So I could talk to you at the end of the day about what we finally want to accomplish, and that is hopefully you leave here with a better understanding about how we can do some of those things. So I think the first thing starts, in my opinion, with your planning for your estate, starts with a document that you have. So I would imagine most everybody in this room has a will, but at the same time, I know there's probably somebody that doesn't. And I'm also guessing that a lot of the people in this room have what we call a trust. And I'm guessing there's maybe a few people in this room that have neither. And this might be right now where I might call on Rachel just for a second, just to say, I could have given you this question ahead of time, but we didn't see each other today. If you were going to explain the difference between the will and the trust, without a lot of detail about either, what would you suggest would be the benefits of one over the other? So with the will, most of the time, the estate that you have, we're going to define estate a little better in a minute, but the estate that you have, if you have a will, you're saying that that's probably going to go through a probate.
If you have a will, yes.
Mm-hmm. And if you have a trust, you're probably going to avoid probate.
Yeah, I mean, usually if you've done the planning right, yes.
Mm-hmm. So then, let's look at those trusts. So you and I talked a little bit about a family living trust, and I'll maybe just talk about it for a second, but ask you questions. So there's two kinds of trusts that I see with my clients. One is a family living trust, and one is the where I'm
disclaimer.
Pardon me? The disclaimer trust. Thank you. The disclaimer trust. So generally speaking, there's two kinds of trusts that my clients that have trusts, they come in and we work with them relating to their trusts. The family living trust is the one that takes more time and more effort and more money to set up. And the disclaimer trust is simply mostly a part of your will, which creates a trust upon somebody's death. They both work. And I don't need a show of hands, but if who has one or the other, but if and Rachel and I talked about this the other day, if we were talking about how we work with our clients, the most efficient type of trust, and there's not just one, everybody's situation is different, but probably the most efficient trust is that thing called the family living trust. And I'm going to take a second and just make sure that you're clear on what that is. Before I do that, there's one other benefit of the family living trust, and that relates to estate taxes. And the disclaimer trust allows for a benefit of disclaimer for taxes, estate taxes as well. But let me explain how the family living trust works. But before I do that, I'm going to ask you the question: who knows what the federal gifting for your estate for an individual or one family? Who knows what that number is? Anybody here? It's raised a little bit. It was 17,000. Okay. I'm talking about for your whole estate during your whole lifetime, $5 million, and it was five. I think it's 5.4 million today. And what that means is, if it's done properly, each of you could give $5.4 million to your family. So it'd been nice if somebody could have done that, right, to us. Who knows what the state of Minnesota allows for? Let me back up a step. I was going to ask it this way. So if you don't have $5 million, do you need a trust? Because a trust allows you to avoid estate taxes if you do things properly. So if you don't have $5 million, should you have a trust? Why? Who said that? That's good. I like the affirmation.
Because it spells out exactly what you want to happen.
There you go. That's one great reason for it. You're right. It spells out by detail exactly what you want to have happen to the things that you're leaving behind. So that's one great reason to have a trust. And what would be another good reason? The state of Minnesota. Exactly, Chancellor. So the state of Minnesota isn't quite so generous, are they? Who knows what that number is? Yeah, I think it went at 1.8 this year. Yeah, and then next year it's going to 2 million. Okay? So if you have less than $2 million to avoid probate, do you think it's worthwhile to get a trust besides that what that young lady over there mentioned, to make sure everything goes where I want? I would suggest that it would probably be a pretty good idea for you too, because we have things change in our life. And let me explain to you what gets added up to go when the State Internal Revenue Service comes around checking to see if they should charge your estate taxes. What do they consider in that process? They consider your checking and your savings accounts, correct? They consider what else? Your investments, your stocks, your bonds, your mutual funds, your annuities. Annuities don't avoid probate. And I shouldn't say that. They can't avoid probate, but they're certainly included in your estate. What else? Yeah, your personal property. I'll almost guarantee you, I almost promise you that somebody in here not only has a house here in Rochester or a condominium or something, but either today own or did own, or their family owns some lake house up in Brainerd area or who knows where, somewhere. And the numbers on those, whether you're a house in Rochester or whether you have an extra one, and your personal property, including your cars, your jewelry, your collectibles, your gold, your silver, all those things can get added up, and it really doesn't take very long to hit that $2 million mark. So, but what changes in your life? Did you have something, Rachel?
Oh, no, I was just going to mention that this young woman over here mentioned her fancy car, too.
Yeah, her fancy car.
Her Porsche.
That was it a Porsche or a Jaguar? All right. Those things add up. And so not only do they add up, but with the exception of a few things like a car, they have a tendency to grow in value. And after a certain amount of time, unless the state legislature changes their opinion again, we're probably not going to see a pay raise above the $2 million mark. They tried to do that but a year or two ago, but they didn't get that done. So here I am. Now I'm sitting at 1 million, 1.6, 1.7, or even 2, a little bit over that. Do you know who you just left as your beneficiary to your estate? If you die, if you're a little bit over, If you're 100,000, 2.1, 2.2. If you have 2.2 million, do you know who you just made a beneficiary of probably $32,000 to your estate? The governor. Exactly. So some people would prefer that that doesn't happen to them. Believe it or not, there's some people that say, I don't care. It doesn't make sense to me, but it's their money. So one of the things that helps you keep this from happening is this idea of a family living trust. And a family living trust might have something like this. It'll have the title of John and Mary Anderson Family Living Trust. And then they go to the lawyer, by the way. They go see Rachel. They go see a lawyer. And they charge them $1,000 or $2,000 or $5,000 or $10,000. It depends on sometimes different things. But and that lawyer prepares this document, and they go in and sign all these papers, and they come out with these two documents, and it's the John and Mary Family Living Trust, and then it's also the Mary and John Family Living Trust, both of them, and they say they're dated January 2nd, 2017. That's what they look like. And then, do you know what some people do after they get that done? What do some people do when they get that done, Rachel? They just go home. I'll answer that question. They just go home. They got their documents in their pocket, and they just go home. And Rachel would never allow that to happen, but they just go home. So if you have a family living trust, and you're one of those people that just goes home and puts that in your safe deposit box or in your important paper box at home, it didn't do you any good. It didn't do you any good. So you have this document that the lawyer drew up for you. You have the document that the lawyer charged you something for, which they're usually always worth it. They really are. And you just go home, and you didn't do anything with it. So what you should have done is you should have called your Edward Jones advisor, and I'm just kind of kidding with that, but you should have called anybody that you have property with, anybody that you do business with, and anybody, if you own something, whoever can help you change the title of that, you change the title to that trust. And now, instead of having 2.2 million, I'm probably going to have 1.1 million in the John and Mary Trust and 1.1 million in the Mary and John Trust, and now I don't have to worry about exceeding that $2 million Minnesota estate tax issue, at least not for a while. Hopefully I hit the lottery or something, or another rich relative died, which I don't have any, but another one may have passed away that I didn't know about. And so now I don't have to worry about that. Do you know what many people tell me? Why they don't do it? Any good reasons? Who could tell me why? Why they don't do it today when they need to? And they're probably worth $4 or $5 million today. Well, one of them is they cost too much. Exactly right. They cost too much. They have to go see an attorney, or they have to spend time with their accountant, and they have to do a little bit of this, and so it's going to cost them $5,000. I don't know. I'm just throwing that number out. I think it's a lot less sometimes, and sometimes it's a lot more. But it costs too much. But I can assure you that what it costs you today saves you bundles of money later on. And again, I'm only talking about the $2 million issue. You could be talking about the 5. The millionaire next door, you can never tell what they look. You can't tell who's a millionaire next door, or the multi-millionaire next door. So we have assets that are exceeding these numbers, assets that are close. Don't let the fact that it costs a little bit of money not to do that. Why else don't we do it, though? And another reason is privacy. They frequently just don't like going to see the lawyers and having to tell everybody everything about themselves. A lot of people are very private, and that's a reason why they don't. It's sometimes a reason why they don't get their trusts in their estate, the things that they own, titled in the name of their trust. So, cost too much, a little bit of privacy, yes.
In regard to titling, do each of these items, say your annuities and all these other things, real property, personal property stuff, do they all have to be titled individually?
Okay, so that's kind of a difficult question to ask, but you would never title your annuity. You said that one? You wouldn't title your annuity in the name of your trust. You might put it as a beneficiary, but you wouldn't title it in your trust. But but to answer your question, sometimes people are still owning their stocks in what we call street name. They own their IBM shares that they bought when they worked at IBM. They own those IBM shares at in street name, and the transfer agent actually holds them. And then they own another company named Fastenal in street name, or they own Xcel Energy because they want to dividend reinvest without having to pay anything, or who knows what it is. If you own things like that, then yes, you need to put those into the name of your trust, or two things will happen. One is they're going to go through probate, and two, those things are in joint name, and joint name doesn't do you any good when you have a family living trust. If you have them in joint name with the disclaimer trust, you can get by with that. Yes, please.
Donna, I was just going to say that this is a perfect example where a financial planner and an attorney can work really well together, because if you've got both, you can go through the assets together, assuming you agree to it, and you can basically identify which assets go into a trust and which ones stay out. It's really about accumulating and looking at the total wealth on the assets owned. So there are possibilities where you don't always have to title everything into the trust. It just, total-wise, you want to just keep an eye on it so you don't exceed that probate number in the assets outside of the trust, if that makes sense. So.
And yes.
Now, can I follow up on your example on this, like John and Mary, Mary and John, family living trust? So the question is, how many family living trusts a couple can have? And also, does each living trust is subject to that 1.6, 1.8 million maximum, or all the trusts add up together?
You, okay, all right, yes, I can repeat that for you. I think. You tell me if I'm repeating this correctly. How many family living trusts can you have? Yeah. And if you have a John and Mary family living trust and a Mary and John family living trust, first of all, I'm going to suggest to you that's usually all you do. But you use this one document to, so I think I can answer it this way, and you tell me if I'm answering your question. And if I'm not, then I'll get deeper. So let's say that you've got a house worth $400,000. You've got a brokerage account that's worth $1 million. You have your savings account and CDs and things like that at the bank that are worth $500,000, and you've got this lake home worth $600,000. Okay, there's four things, and all those numbers added up to $2 million. Okay, and this is not, I'm not telling you have to do this, but this is just a good example. So you would perhaps take that $1 million account that you had at Edward Jones, and you'd come and see Don and say, we just finished our work, and we're going to title this in the John and Mary Trust. And then I'm going to take my house and my lake home and my my savings account and CDs, and I'm going to put all of them in the Mary and John Living Trust. Okay, so now I just utilized one trust for my Edward Jones account, and I utilized $1 million for the other trust for all those others. Now, if a person was going to establish another trust, the answer to that question is you can't exceed, you can have up to $2 million in this trust and $2 million in that trust and not pay any Minnesota estate taxes. Okay?
Even though the total of them
Is 4.
4 million.
Even though the total is 4, I could get $2 million titled in this one trust and $2 million titled in this other trust.
Okay.
And then the terminology, I'm not sure if I answered your question about multiple trusts, but you can, one trust document can be used for all of it, or you can split them up evenly, which is kind of what I said is the best way to do it.
Yeah, yeah.
Okay?
So,
Would you agree with that, Rachel?
Hard until you
Yeah.
look at, all of the, it's really hard because most of this is so individual. So, that's what that's really ultimately what you're paying for is really that personal.
yeah.
It's hard to do just general summary statements on estate
Right.
planning. But yeah, I think that's,
I think my best example to summarize is I could put $2 million in John and Mary, $2 million in Mary and John, and now nobody's going to pay any Minnesota estate tax next year. Today it's $1.8 million.
So the 2 million example is you're based on the 2 million Minnesota, maximum exemption level, right?
Right.
How about, okay, in this case, there's another 401k account
Right.
worth about $600,000.
Correct.
So can this couple establish a third, family living trust?
Well, okay, we're going to get to that, but so we're going to talk about qualified plans in a little bit. But those, if that 401k is in John's name, and then it can't be titled in the name of John. Okay, so that you cannot put, the trust cannot be the owner of a 401k. Only a person can be. So you can make a beneficiary your trust. You make the trust be the beneficiary. But you're maybe, now what you're saying is if I had $2 million here and I had a $600,000 401k, I've got 2.6 here.
Or add up together 4.6. So I guess the question is, what happened in terms of the Minnesota estate tax?
You'd pay taxes on 600,000
on 600.
if we were at 4.6.
Okay.
Okay. Yes.
That's the same type answer for IRAs?
Yes. Yes, it is. Good point. And I'm going to get to those in a little bit. But yes, absolutely. That's a very good question, very good point. Is somehow we want to make an allowance for those things in this planning process. Even though they can't be titled. See, they avoid probate. 401ks, IRAs, annuities, they avoid probate. But they still get added into the estate tax issue.
They wouldn't be in the living trust,
They would not be titled in the name of your living trust.
but you could make your living trust the beneficiary.
Correct. Mm-hmm. Yes.
Is a single person limited to one trust then?
Yes. Now that's a good point. So I was going to get to this. She asked, is a single person limited to one trust? Yes, they are. And that's where I was going to get to when I was asking, why do people wait? Well, if they wait because I'm not going to die. That's why they wait. And so they wait, and that's people frequently why they don't do wills, frequently why they don't do a trust, because, well, I'm not going to die. When it looks like we're going to die, then we'll go get that trust work done so we don't have to do the estate planning right now, because I'd just rather not do it. I don't like to face it. I don't like to pay for it. I don't like to take the time with it. I've got many other things to do. And when I get sick, I'll probably go in and take care of this. But here's what happens. Once one person is gone, it's too late to establish a disclaimer trust. It's too late to establish a family living trust once one person is gone. So the greatest reason why I find people don't do it is they truly just don't think they're going to die. So, and we all know that ain't happening, right? So, let's keep on this. You've got some good questions here for me, and Rachel. Any other thoughts on this? So yeah, I know I made it sound like everybody here should leave and go get a family living trust. Believe me, that's not what I'm telling you. I'm doing this for education purposes, and each of you individually, as Rachel said, would need to really do your best to say, okay, I should get my house in order. And by the way, there's crazy wealthy people that die with wills, and they pay a lot of estate taxes. And we've got all kinds of good examples of that. We've got crazy wealthy people that die with no wills. Who in Minnesota do we know that pulled that one on him, on his family? Yeah, Prince. So, and so when I said a little while ago, I know there's somebody in here that probably doesn't have one. That's what the stats say. The fact that you're here maybe discounts that. The fact that you're here probably tells me you do care enough and you do some planning, and so you probably have done some of this work. So, any other questions on these trusts? These trusts? Yes. Okay. All right. So I'm just going to give you the most common example. There'd probably be many. So the most common example of a revocable trust is what most trusts are when people are alive. So there's a couple that has their family living trust or their disclaimer trust. Those are almost always revocable. I can go in and talk to my lawyer, and my son did something that I didn't like, and I'm going to take him away from being the trustee, or I'm going to take him out as some sort of beneficiary, who knows what. Those things, and by the way, trusts are very, very flexible, and they're very easy to work with. So when they're revocable, and they almost always are, revocable means I can change them. And the terminology for an irrevocable trust frequently comes into play with after one of the people that was one of the spouses dies. So I had this family living trust. I kept these assets that were in that trust. I kept them there, and for purposes of estate taxes, the terminology revocable frequently goes to that. That account carries a tax ID number. It gets taxed a little bit different. It gets a stepped up value, which we'll talk about in a minute if we got 2 hours. and so usually there's not a lot we can do different with that one once the one person passes away. So that usually carries that irrevocable terminology with it. You can usually change trustees. You can usually use the income out of that trust. You can usually use that asset for special purposes when you need to. But that usually goes through a process of getting stepped up, and it kind of sits there over by itself. The other trust of the spouse that's alive still is still revocable, and it's still just operating the same way it always was. And it's probably growing in value. Okay? Good question. Yes?
You mentioned probate.
Mm-hmm.
How much does a probate hearing cost? And is there a certain amount of wealth you must have to trigger probate?
Can you answer that for me, Rachel?
So, I'm sorry. Probate is triggered. I believe it's $80,000 now. So if your assets and they don't transfer to a trust, or they don't have a designated beneficiary, and it's over that amount, it goes into probate. And probate generally takes about 9 months to finalize. It is public, and it's usually $3,000 to $5,000 depending upon the assets. it's, you can still, and the other thing to just be aware of is that you can still have a will and still go to probate. So just because you have a will doesn't mean that you are avoiding probate. It's, it can, yeah. I mean, it really depends on the assets that you have and how you are transferring them or how they transfer by the will or by law. And so that's why it's always hard for me to, I can't give like individual legal advice here, but it really will depend on what you have. So like usually your checking account, sometimes you can do what's called a pay on death, and that can go that way. But I'll tell you one example I just had is a client of mine. They thought they had a pay on death designation, and the bank actually made a mistake. So there's all kinds of reasons why having, making sure your things are in place. And one of the things you're paying for from a financial advisor and from your attorney is double checking that the asset designations are proper and that they will pass the right way.
If you have a will and you have beneficiaries applied to all your good stuff,
It,
I mean, your car, your house, your valuables, and you kept it under, and what you had left was under $80,000, and that generally would not trigger probate.
yeah, that's correct. So if most of your things have some kind of designation, you can avoid probate, but just it's easy for things to add up very quickly, and you really have to keep an eye on what those assets look like. And that's so just I hesitate to tell you that because, and like I said, one example is they thought they had the designation correct. The banker actually made a mistake. It was a new banker. They didn't do the designation correct, which triggered probate, even though the person who passed away thought they had done all the designations correctly, and were told by the bank that they were done correctly. Right. You want to double check. You want to pull the statements, and you want to see how the bank has recorded it too.
Can you add a little bit to the list of things that are not involved in probate, as in 401Ks and annuities and things like that? Does that stay pretty much the same over the years?
Well, I heard the terminology a moment ago. What if I have beneficiaries on everything? So your 401k should have a beneficiary. Your checking account at the bank and CDs at the bank should have POD beneficiaries. Your account at your financial services firm, I've been joking around saying Edward Jones, it's easy for me to do that, should have transfer on death if it's not an IRA. So IRAs, 401ks, annuities, brokerage accounts that have TOD, transfer on death, bank accounts that have POD, pay on death. Those things allow you, and by the way, houses can be put in POD or TOD. Your home can be.
Generally speaking, anything with a beneficiary designated kind of avoid.
That's probably going to avoid probate. But the assets that you might have outside might still cause the probate to occur. Go ahead. I'm sorry.
No, Don, I think that's right. The other thing I was just going to mention is if you have children, if you do, even if you decide you just want to do a basic will, there are ways to designate your personal effects. And you'd be surprised about how important personal belongings become to your kids. So one of the things you kind of want to make sure too that you've got some designation there as well. Right. I mean, you'd be surprised at how many people will. I mean, the yellow teapot means many things to many people, and you can talk to your kids about that. That's something you can sit down with them and share.
All right. We're getting there pretty good. Let's talk about some ways that we can reduce our estate. And and that's through this process, pretty much through giving. And so what kind of giving do we do? I'd say there's pretty much usually two kinds of giving. Who's our favorite beneficiaries usually? Our family members, right? And how much can each of us give to a family member? A lot of us have heard this. Or 14,000 is still the number, correct? Per person. Mm-hmm. Any individual can give any individual $14,000 in a year. No. My checking account number is 5872. I'm just joking. You could gift to me if you wanted to.
So that family member is taxed on that 14,000.
No, nobody is taxed. If you give $14,001, then you have to file your form something, your gift tax form. But nobody pays tax on that. So when you give, let's say that I actually gave $20,000 to somebody, which you can do, nobody's going to pay any tax on that right now. Maybe never. But I do have to file a form. I do have to claim that I gave away $20,000 in that year, and I have to file the form with my taxes, and it's called the gift tax form. It's got a number, but I don't remember what the number is. And what that does is it subtracts from your $1.8 million gifting allowance. It just subtracts from there. So if somebody has $1 million and that's all they have, which is a pretty good number, but if that's all they have, you can gift that. And nobody's going to pay any tax on that. It's just going to subtract from that $1.8 million that the state cares about.
You mean the recipient would not have to pay tax on that 1 million?
Nope. Nope, nobody pays tax. So sometimes people go ahead and they give a lot more than that 14,000 because they perhaps are giving assets like land or securities. And I'm not saying that that's the best gift to give when people are alive, but they give that because they want to get that growth out of their estate and let it grow in the kids' estate. And so now I don't have this asset growing in my estate, and when I die, I'm maybe only going to have $200,000. Sometimes they do that very aggressively, and they used to do it more. Why did we do it more a few years ago? Get a bunch of money out of my estate to avoid having to spend that money when I go to the nursing home. That's why we used to do it. We don't do it so much anymore because what have they done? They've made that look back go back quite a ways. And so people are less likely to say, I might be here 15 years from now, and I got to go back 5 anyway, so I'm not going to do that. So the point here is I can give $14,000 and not have to worry about that gift tax form. If I give 20, I got to fill it out. You still don't have to pay tax on it. Yes.
So on gifting, you can take $14,000 out of a taxable account like a traditional IRA and no taxes due.
No, there's no estate taxes due. But so we're going to get into that issue, right? We'll just go right into that issue that really describes a little bit about what I'm going to talk about maybe for the last few minutes here, and that's the smartest way to gift. The smartest way to gift. And everybody's situation is different. So I might not be telling you personally what the smartest way to gift is, but let's give it our best shot. So when I'm gifting to my family members, let's use these kind of key words here. By the way, we said one place that we gift to is our family, right? We just said that to start with. Where else do we do this gifting? Charities. To our charities. So let's primarily talk about those two issues. What's the smartest way to gift to my family? What's the smartest way to gift to my charity? What's the smartest way to leave in my will or my trust to my charity? and leaving my will and my trust to my family. Let's try to get as close as we can to that. Let's first of all talk about while we're alive. Okay? While we're alive. You mentioned this, gifting out of my IRA to my children. So I'm going to stay on that one right away. You probably don't want to do that. And so the reason now I would say you probably don't. If that's your largest assets and the place that you don't miss it if you give it, then give all you want. But for tax reasons, that's probably not the best thing to do. So the best place to gift from your IRA, but I got to raise you up a little bit, some people in here, is when you're 70 and a half, is to gift to your charities from your IRA when you're 70 and a half. And the reason for that is that's the only way that you can get money out of your IRA tax-free. That's the only way. Any other time that I take my money out of my IRA or out of my 401k, any other time I take money out of those things, I'm going to get taxed. So right now where I see the biggest mistake people are making is they're giving $5,000 to their church from their checking account. From their checking account. What's the problem with that checking account? It's already been taxed. And then I've got to take my required minimum distribution of $5,000, and I'm going to pay tax at 24% by the time the state and the federal get a hold of that. And then I get to keep what's left over and put it in my checking account. So where I'm going with this is the law that allows you to gift directly from your required minimum distribution at age 70 and a half, the law that allows you to give directly to your charity allows that money to go to that charity completely tax-free. You pay no state or federal tax. Okay?
How do you do that? You designate it for?
Whoever is responsible for your IRA account, if it's Don Charlson and Edward Jones, you'll call me and we take care of it for you. It's very, very simple. We need to know the routing number or the address of the charity.
Is this only apply to the RMD or
Yes.
what happened you're before 70 and a half?
Yeah, if you're 68, they don't, for some reason, they don't let you do that.
Okay.
I don't know why. They've probably 6-7 years ago is when they first made that law. And they even made it so ambiguous 6-7 years ago that they told us in January that if in December, so they tell me today, this is how they did it for 3 years straight. They tell me in January that any gift that you gave to your charity out of your IRA, if you're 70 and a half, we're going to allow it to be tax-free. They didn't tell us in December. They told us in January from the previous year. And then 3 years ago, they made that law so that it's not year by year, and they made it so that it's every year. And it's a really nice benefit. It's a nice benefit for a charity because they get the money tax-free. You get a gift that would have been taxed at X amount, 15, 25, 35%, and you get to make that gift completely tax-free. So that's a great way to give to a charity. And so should you not give to your kids out of your IRA? Well, maybe, again, if you're under age 60, under age 70 and a half, maybe it doesn't make much difference. But there's probably better ways to give to your family. Here's another mistake. I'll refer to it. It's not necessarily a mistake, but the best example I have in this room is people that own IBM stock, and maybe we could say Fastenal stock. And they bought it for life. Since they were 22 years old, they had their first job, and they worked there until they were 60. And they were buying IBM stock at the equivalent price of who knows what. They actually don't know either. And they paid probably $10 a share for it. And then maybe later on they paid $30 a share for it. And later on they paid 40, and later on 80, and later on 100. And they have these piles of stocks there, and they say, we're never going to spend them. Let's just give them to our kids. Well, what you did when you did that was you just gave your kids a nice gift, but it's something that if they ever sell it, they're going to pay taxes on the price that you paid it, the price that you paid for it. So giving an appreciated asset, if we had farmers in here, we'd maybe talking about gifting land that they paid $1,000 an acre for, and today it's worth $8,000 an acre. And they do that. They gift it. Maybe there's a good reason to gift it, but for tax purposes, a bad reason. Because when that child receives that land, they get it at the price that it was paid for by the parent. And who knows, maybe the grandparent. So when you gift that, or not gift it, but when you pass that IBM stock or that Fastenal stock or that land, when you pass that on to those children through your will or your trust, then it gets the new value at the date of death. So if I paid $15 a share for IBM and I gave it to my kid today, and they sell it, they're going to pay capital gains tax on the difference between $15 and $173 a share, if that's what IBM closed at today. They're going to pay tax on all of that difference. If I died tomorrow and I passed it on to them, they wouldn't have paid any capital gains tax if they sell it. They'd pay zero. Because that land, that IBM stock got stepped up in value for my kids to receive when they received it. I gave it to them today. They get it at $15 a share. I died tomorrow, and then I still own it, and then they get it through the will. Then they're going to get it at the equivalent value of $173 a share. Now they sell it at $173 a share. They don't pay any tax, estate gift. They don't pay any capital gains tax. Yeah, so gift carries old value. Death, that's good. Death carries stepped up cost value. Stepped up basis is the terminology.
But gift is subject to this 14,000 per year limit.
I just kind of, okay, and so I'm going to apologize to you. I kind of stepped away from estate taxes. But to answer your question, it still applies to that, yes, for estate tax purposes. But for capital gains tax, you're going to still get capital gains tax if you give them the value while you're alive. So, if you give them we'll stay on this topic. If I give them $14,000, if I give them $14,000 of IBM stock, they're not going to have any estate tax issue. But if they sell that stock, they're going to pay capital gains on the stock. Okay? Whenever it's sold. But if I die and I leave it to my kids, then there's no capital gains tax.
Well, if it would appreciate after your death, then there would be.
If I die and it's at $173 a share and they sell it at $173 a share, there's no capital gains. But if they own it for 10 more years and it's at $350 a share, they'll pay the difference of $173 to $350. Good. I'm glad you asked that question.
So in this example, stock would be the best, to give to your children, right, when you die?
As in your estate, yes. Right. Stock, any highly appreciated asset. I refer to it that way. So now let's go back to this other question. I've got, let's use this example. I've got this IBM stock that I'm never going to spend, so I give some of it to my kids. I told you that wasn't the best place to go. I've got $100,000 in CDs and cash at the bank, what would have been better to gift to my kids? The CD and the cash. All right, the $14,000 in cash. All right, so now let's talk about the charity. So I already explained to you that a charity, gifting to a charity through your required minimum distribution is a great way to go. But let's go back and do the same example. Let's say I don't have my RMD like we were talking about, but I've got 500 shares of IBM that I'm never going to spend. Should I gift the cash to the charity, or should I gift the shares of stock to the charity? The stock. Exactly right. So I'm going to gift these shares of stock. I'll give the cash to my kids. I'm going to give the stock to the charity, because the charity can receive those shares, and they don't care what you paid. Uncle Sam doesn't care what you paid for it. The charity is going to get those shares of IBM. They're going to sell them, and nobody pays any capital gains tax, and you get the full value for the gift.
By gift, in the example of the stock, by gift, you mean your estate gift.
No, when I'm talking about the charity, we're just reducing the size of my estate, and we can gift as much as we want to them. So that 14,000 or any gift tax forms or anything like that don't count.
Yeah. But how about in the example of giving stocks to kids?
If you give $14,001 of equivalent value of a stock to a kid, you're going to have to file a gift tax form.
Right.
If you give 10,000, you don't have to.
Yeah.
Or 14,000.
But how about in the case you talk about the stock is part of the estate? When you die, you designate that, for example, via POD or POD
Yep.
to your kids. So
Okay.
do they have to pay capital gain tax?
No.
They don't?
No, they don't pay capital gains tax, and the estate tax could come into play if when you add in IBM and all those things, whether or not you have TOD or beneficiaries or anything, they're still going to get all added up, and that's still going to add up to that, we'll refer to $2 million. So I'll make it at least one more year. Okay? So, good summary here is when you're talking about your charities, do your best not to give cash to them. Give as much as you want to them. I'm not trying to suggest don't give. I'm saying, in fact, when I'm talking to my clients, every year we're talking about the required minimum distribution, they almost think I'm trying to encourage them to give to charity. That's not my point. My point is if you are giving, you're putting $10 a week in the basket as it goes by me. That's $520 a year of cash that you gave to the church. And you could have given either the highly appreciated asset that you're never going to spend anyway, or you could have given the required minimum distribution out of your IRA or your 401k. It's harder to do out of a 401k, but it can be done. Okay? So cash to the kids, and usually highly appreciated assets, or your RMD to your charity. Make sense? So why did I bring this up today? I brought this up because here's the best way to reduce the size of your estate. I didn't say this, but I'm trying to encourage you to reduce the size of your estates if you can do some planning and do some pre-planning. But what's the best way? What's the best way for you to reduce the size of your estate? Take the kids to Disneyland. That's the best way. Take the grandkids to Disneyland. In other words, spend it. Yeah. Now, I know that goes against a lot of ideas, but that's, in my opinion, one of the best ways. But we all know, I've got clients that hate spending money. They saved all their life. They never bought a new car. They hardly ever traveled. Funerals and birthdays of their kids somewhere far away, they went somewhere. They just lived in their house that they paid off 25 years ago and just keep on generating assets. And it's hard for them to spend. I love telling them to do it, but they hardly ever do. But if you can't get that done, then let's consider doing this. Let's gift to our families while we're alive so they can say thank you to us. Let's gift to our charities while we're alive so that they can say thank you to us. And I can see the benefit of doing so. And by doing this, you can reduce the size of your estate and perhaps still have plenty of money to live on. And again, I had something up here that showed all the, I can't tell you that you should spend it down really low because I don't want you to run out of money. I can't tell you should be gifting away to your kids because you might run out of money. I can't tell you that you should be gifting to charities because you might run out of money. But that's all part of this plan. And I can't think of a better way that if it all works right by you planning, that you can enjoy the benefits of your money and maybe not necessarily by just spending it. So I hope that makes sense. So the conversation today kind of went probably two different ways here. And it was first of all your planning, getting your attorney and getting your CPA involved, and getting your banker or your financial advisor involved, and then getting that plan, having that will or having that trust, and having things in order. And then the second thing is, I've got this much money, and I'm never going to spend it all unless I start doing something. And that's what I was trying to encourage you with this idea about doing your gifting. So that's the only two things we got covered tonight, Ann. And you had wonderful questions. I really appreciate the feedback or the give and take here. I have my card. I don't have Rachel's card, but I could certainly get you in touch with her or another attorney, perhaps. And you all perhaps have trusted people you work with, but I'll just throw this out. If for some reason you had a desire or a need to meet with me or call me and ask questions, I've got my card there, and I'd really appreciate your feedback. So I handed out this form for you, and I value that because I do get a chance to speak now and then, and when I know that, one, I could add a little bit, or two, I could subtract something, or three, try not to quit picking your nose while you're talking in front of the group because it's annoying. Whatever it might be that you could add to your feedback, I would really appreciate it. Yes?
Can I have one last question?
Sure. Mm-hmm.
You mentioned TOD or POD can be done for house, right? And I know that, and we did that for Minnesota. How about for out of states? Is it usually the case or usually not the case?
You mean if you own a property out of the state?
Second home, for example, in Arizona or something. Is Arizona state law, do they have this TOD or POD on houses? I mean, I'd be wrong if I'd answered that question. I think so, but I can't promise you that that's the answer.
For certain, Iowa does not. You cannot.
Yeah.
On a real asset.
Okay.
State by state.
It's state by state.
and then if not, what's the best way to handle to avoid probate?
Well, you mentioned, yeah. If you have a home in Arizona, perhaps there's pitfalls to doing this, but list one of your children as a co-owner of it. Huge pitfalls of that. Rachel just went like, oh, you didn't tell him to do that, did you? but that will avoid probate. Another living name.
I think if you've got some property in multiple states, or you have lake property, please don't just leave it to designations. You really need to go in and get a plan.
Yeah.
You need something. Yeah, I would not. I couldn't in good faith let you leave and think that it's okay to just.
That's good. I'm glad you brought that up. Yeah. So the the emphasis would be there is do some good planning. And the TOD and the POD is so easy to do in my office. It's so easy to do. It's bank. But it may not be the best thing to do. Any other questions? Well, once again, I was starting to wind this down. I really appreciate you being here tonight, roughing the cold weather so that we could speak to a very nice group of people. I told Ann if there was only 3 people here, I'd be delighted to carry on this conversation. And I hope it was a benefit to you. Please, if you could, maybe, Ann, what do we do with these forms? Can we just leave them in the back of the room, or do you want to leave them where you were sitting? These,
Yeah, it doesn't matter. What if you want to just put them right back on the back table on your way out? That's great. You want to pull a name?
That was not fair. I picked the last one in, probably. Oh, look at her, Mike Reister.
Where is he? Where is he?
Right back here.
Oh God! I'm like I know he's here. Okay, you get a coffee mug tonight. So exciting. All right, thank you, Don.
Yeah, my pleasure. Thank you very much.
Come back next week. Celebrate Valentine's Day with us. Danielle's bringing chocolate.
Thank you, Rachel.